best thing about a buffet dinner? The selection, of course. You're bound to find something that hits the spot no matter what your tastes, dietary needs, or appetite level. Not into the pork back ribs? No problem. The salmon fillets are divine. In the mood for something more adventurous? Try the Thai red curry. Different items on the menu satisfy different cravings, and that's exactly how financial products work in your portfolio. Think of them like the menu items in the buffet dinner of your financial future. Your portfolio is your plate, and you fill it up with a unique mix of investments that suit your goals and risk tolerance. Or should I say, risk appetite. Thankfully, for hungry investors, there's a veritable smorgasbord of investment options to choose from. Let's see what we're cooking with. Broadly speaking, we can break them down into two major categories: equity and fixed income. Equity investments offer investors partial ownership of a financial asset, such as a company or fund, in exchange for their money. The most common example is company stock. When an investor buys shares in a company, they're actually buying a tiny stake in the business. They're hoping the money they provide helps the company grow and therefore increase in value. If the business grows and its stock price rises far above what the investor paid, they can earn a high return. But if the business doesn't succeed and its share price falls, then the investor can also lose a lot or even all of their money. So we can see equity as the Thai red curry of our buffet example. It's the riskier or spicier investment class. When investors talk about equities, you'll often hear the term market cap brought up. It's short for market capitalization, which is a fancy way of saying how much money the business is worth. Generally, the larger the market cap, the more established and predictable the business. But larger companies also tend to grow more slowly and may not have much room for share price growth as smaller ones. Smaller caps, on the other hand, can be less established and more volatile. They might grow more rapidly and have more room for share price gains, but they can also carry more risk and uncertainty, especially those companies that have yet to generate a profit. Some like it hot, but for others, a milder alternative is more appropriate. One way investors can potentially turn down the heat is through equity investments called mutual funds or exchange-traded funds, often referred to as ETFs. Investors can purchase units of the fund to gain exposure to a small slice of many different assets, sort of like that pizza with all the toppings on it. Mutual funds and ETFs spread out an investor's risk across many investments, so even if some falter, others pick up the slack. The key difference between the two is that mutual funds tend to be more actively managed. They're run by professional managers who try to achieve higher returns by buying and selling assets within the fund based on the predetermined fund objective. Meanwhile, some ETFs are designed to mimic the makeup of a specific market index or fund, and they aren't tinkered with that much. You can learn more about the differences between ETFs and mutual funds by watching our video course, Investing in ETFs and Mutual Funds. So, if equities are on one side of the buffet table, on the other side is the second major investment category, fixed income. This is often referred to as debt. Bonds are a common example of fixed income. You can think of these products as loans from investors to borrowers for a set period. In exchange, they receive their money back once the time is up, plus regular interest payments along the way. Fixed income investments provide a steady rate of return that is typically unspectacular, and they're generally considered lower risk than equities. This is because they are often backed by real assets owned by the borrower, like product inventory, equipment, or real estate. So if the borrower were to default on their obligation, investors would receive at least some compensation. Now, not all bonds are created equal. There are different grades with varying levels of risk typically associated with them. For instance, government bonds tend to be safer than corporate bonds and carry less risk of default. But the trade-off is that they sometimes offer lower interest payouts. Generally speaking, though, bonds are predictable, safe, and a little bit boring, sort of like roasted potatoes. Of course, they can also be very satisfying for investors who crave more certainty. Guaranteed Investment Certificates, or GICs, are a form of fixed income that many Canadian investors hold. Like bonds, they require investors to tie up their funds for a defined period in exchange for regular interest payments. The key difference is that the investment is covered by the Canada Deposit Insurance Corporation for up to $100,000. So there's very little risk involved, but they may also offer lower interest in return. There is another trade-off. If investors want to yank their money out before the end of the term, they may have to pay a penalty and possibly forego all interest earned during that period. One other asset class we'll touch on is money market investments. Treasury bills, bank certificate deposits, and corporate commercial paper are a few examples. They're sometimes called cash equivalents because they don't offer much of a return beyond what an investor would receive simply holding cash. But they carry very little risk and are highly liquid, meaning they're easy to buy and sell on a whim. So investors often hold them when they want to be certain their money will be there when they need it. Equities, mutual funds, ETFs, fixed income, and money market products are the main dishes of many portfolios. But there are many other alternatives, side plates, if you will. Real estate is one that's familiar to many investors. They can purchase a residential property to rent out to tenants in exchange for monthly rent. But that often requires a sizable down payment, so some investors opt for real estate investment trusts instead. They invest in either properties themselves or in mortgages written to property owners and developers. And they provide investors with regular payments called distributions. There are so many more we could touch on, but we'll leave the rest of our tour of the investing buffet table for later. Now that you have a sense of what goes into your portfolio, you can start to imagine how you'd like to fill yours up. Just keep in mind how you'll be paying for it all. Because it's not just what you buy that matters, but which currency and account you use to pay for it as well. And that's the subject of our lesson, how to use US dollar accounts to reduce currency conversion fees.